Hey guys, welcome. It's Monday. We have our last week before we go into our AP exam. So, right on pace. Today we're going to talk about monetary policy. This module will be due on Wednesday. And then Wednesday, I'll assign a bunch of practice problems for us to do and kind of go over the rest of the review material and maybe some practice FRQs. That way we are all good to go. Next week, we begin our AP exams. Hopefully, you guys are still taking your AP Econ, and well, I wish you the best of luck. But let's not get ahead of ourselves. We still have 1 week left to go. So I thought we'd start off by reviewing. Um, well, today we're going to do monetary policy, and monetary policy is going to be looking at. Let's hide this little guy right here. Monetary policy is going to be looking at how the Federal Reserve can fix the economy. And so that brings us back to this image I showed you in class. Um, Back in Unit 3, what we're looking at here is it's a cartoon that I saw in college, and I've always really liked it. So you've got a broken pipe here, and the pipe is representing the U.S. economy, and it's leaking. And so Uncle Sam is showing up to fix it, and he's got two tool chests he rolls in with. He's got a fiscal policy tool chest that we covered in Unit 3, where you can mess with spending, government spending, and taxes to fix the economy, or you can show up with monetary policy. And the Fed, or the Federal Reserve Bank, handles monetary policy. So, whoops, stay on that screen. So, how the Fed stabilizes the economy. And that's going to be the tool chest we're looking at today. So, these are going to be our shifters of the money supply. Last class, we looked at our money market model. And in our money market model, which is right up here, we were looking at the demand for money, more money demand, money supply. We're looking at nominal interest rate and the quantity of money. Now, for homework last night, we talked about money demand, right? Increasing or decreasing money demand. Didn't quite get to money supply in our last lecture because money supply is controlled by the Federal Reserve Bank. So the Federal Reserve Bank is going to increase or decrease the money supply to try and influence the economy. And you're thinking, well, how does that work? Well, if we can remember, our aggregate demand is made up with C, consumers, I, business, G, government, and XN for trade or net exports. So interest rates are going to play a big deal with these two. Why? Because if interest rates go down and I'm a consumer, I'm thinking, heck yeah, I'm going to go take out a loan. If I go take out a loan and spend it, I'm going to take out that loan and spend it, then aggregate demand will increase and shift to the right. If interest rates are low and I own that bike and bagel store that I'm dreaming of and I talked about last class, well, that means I'm going to take out that loan. I'm going to go buy some new bike stands and some new stuff to fix bikes. I'm making an investment. I'm spending it. So businesses would also increase their spending and move aggregate demand. If interest rates go up, if interest rates increase, well, I don't want to go out and buy something expensive that's going to require a loan if interest rates are high. So I'm not going to do it. Interest rates go up. I'm not going to borrow money. I'm not going to spend money. Aggregate demand is going to decrease. Businesses are thinking the same thing. Interest rates go up. I don't want to install a new parking structure outside of my business for cars because that's really expensive. That's going to take a huge loan. And with higher interest rates, man, I don't want to do it. So aggregate demand would decrease and shift to the left. And you're thinking, okay, cool. So how does all of this relate to money market model? Well, shifting the money supply is going to affect our interest rates. If the Fed decides to increase the money supply from MS to MS1, our new equilibrium is showing a decrease in interest rate. And that leads us into this scenario right here. Decrease interest rates, consumers borrow more money, aggregate demand goes to the right. Businesses borrow more money, aggregate demand goes to the right. If the Fed wants to slow the economy down, they can decrease the money supply. And starting back at our initial MS right here, if the Fed decreases the money supply to MS2, that's an interest rate too, we can now see the effect on our interest rate has increased it. If you increase the interest rate, I'm not borrowing money. Aggregate demand goes to the left. Businesses, I'm not borrowing any money. Decreasing aggregate demand is going to shift to the left. So that's what we're working today. Monetary policy is going to be affecting consumer spending and business spending because they're changing the interest rates. Sweet. So let's get back to this and see what in the devil, hello little fellow, what in the devil is actually going to shift our, gotta remember to click off the screen every time I press that forward button. What is going to shift our money supply? So 3 shifters of money supply. The first one, oh, actually, here comes the list. So the Fed can adjust the money supply by 1, setting or changing the required reserve ratio. Second, they can change the discount rate, and that's the rate in which they lend money to banks and thrifts. And a thrift is another type of financial institution that makes loans, kind of like a credit union. So they'll call that changing the discount rate. That's why I left that one in red. So first one, changing the required reserve ratio, red, shifter number 1. Discount rate, number 2, changing the discount rate. And finally, the third and most important is open market operations. And this is the buying and selling of bonds on the open market. We are referring to that as quantitative easing sometimes. So let's get my guy in the middle here. No, let's put him over here. Yeah, little dude. All right, if there's a recession, what should the Fed do to the reserve requirement? And let's explain the steps. All right. So if I'm in a recession, I know I'm going to want to put in an expansionary. Let's break this over to another screen real quick. Give me a squiggly so I don't lose screen. So if I'm in a recession, just like in fiscal policy, I'm going to want to put in an expansionary monetary policy. An expansionary monetary policy is always going to be an increase in the money supply Why? Because it's decreasing the interest rates whenever there's a recession. If we are in an inflationary gap, we have to go the opposite direction. We want to make it smaller. We want to have a contractionary monetary policy. What does that mean? We need to decrease the money supply. And what effect will that have? Well, that is going to increase our interest rates. So, an inflationary gap, we're going to have to increase the interest rates. That way it curbs our spending. And in a recessionary gap, we're going to decrease our interest rates. But the easy way that I like to look at this to remember is if you are in a recession, you need to have an expansionary monetary policy, and you have to increase the money supply. Expand the money, expansionary monetary policy, expand the money supply. Inflationary gap, contractionary monetary policy, decrease the money supply. So they kind of help, they play back and forth with each other. All right, well, I was going to talk that one out, but let's put my dude somewhere there, play that button right there. So if there's a recession, we know we need to have an expansionary monetary policy. What should the Fed do? Well, let's decrease the reserve requirement ratio. When you decrease the reserve requirement ratio, that means banks have to hold less money in their required reserves, which means they have more excess reserves. If you have more excess reserves, that means more loans. More loans equals more new money. The money multiplier will have a greater effect. This means banks are going to hold on to less money and they'll have more excess reserves. So banks can create more money by loaning out the larger excess. They have more excess reserves. And check this one out, by decreasing the required reserve ratio, you're actually growing the money multiplier. So that's going to have an increase in the money supply. Interest rates are going to go down and aggregate demand is going to go up. So I made a little, pre-made this one. Let's put it over my answers for that one right there. So if there's a recession and I want to grow the money supply, let's assume originally that this is our bank balance sheet right here. And our reserve requirement ratio is 20%. So in this case right now, I have $1,000 in my checkable deposits in this bank. This bank holds on to $200 because sorry, that shouldn't have been a percent. That should have been a percent. Sorry. They hold on to $200 because our reserve requirement ratio is 20%. Our excess loans are $800. This bank right now, they can make some initial new loans of $800. In the long run, they can also make a maximum increase in the money supply of, let's use our equation. So the total increase in the money supply, or a maximum increase in the money supply over time, is our total change in money supply equals our initial new loans times our money multiplier. With a required reserve ratio of 20%, to solve for my money multiplier, I would say, let's put it right here, my money multiplier is 1 over the required reserve ratio, which in this case is 1 over 0.2. My money multiplier is 5. So with a 20% required reserve ratio, my initial new loans of $800 times my money multiplier of 5 is going to give me a maximum increase in the money supply of $4,000. Now, if the Fed decided they want to increase the money supply because we're in a recession and we need an expansionary monetary policy, what do? Let's drop the required reserve ratio. Let's drop it, required reserve ratio, to 10%. Now, what's the required reserve of $1,000? They only have to hold on to $100, which means my excess reserve is $900. So right off the bat, with my initial new loans, has now jumped to $900. They can already create more money, but this is compounded because my required reserve ratio dropped, which means my money multiplier increased. So in this case, my money multiplier is 1 over the required reserve ratio, or 1 over 0.1. So my money multiplier is 10. So my initial new loans of $900 times my multiplier, money multiplier of 10, by dropping the required reserve ratio, the Fed effectively increased the money supply by $5,000. They moved the money supply to the right. They moved my MS to MS1 and dropped our interest rates. Now, how does that help? Well, because with lower interest rates, consumer spending is going to go up, business spending is going to go up because these guys are taking out loans at the lower interest rates, and that's going to move aggregate demand to the right. Cool. I'm not going to do the math for the contractionary because I think we should be able to get it from here. So let's talk about it in the opposite. If there's inflation, if we're in an inflationary gap, well, we need a contractionary monetary policy. We need to decrease the money supply to increase the interest rates. So what should the Fed do? They should increase the required reserve ratio. If it was 10%, hey, make it 15, make it 20. If you increase the reserve ratio, banks hold on to more money. They're forced to hold on to more money in their bank, and so they have less to loan out to other people. They're going to create less money, and the money multiplier is going to be smaller because a larger reserve requirement ratio is going to cut into the money multiplier. So money supply decreases, interest rates go up, and aggregate demand goes down, which is a shift to the left. So that right there is step one, how the Fed can influence the money supply by changing the required reserve ratio. Number two, the discount rate. And we're going to talk about why this name sucks in a little bit. So the discount rate, is the interest rate that the Fed charges commercial banks. You're like, well, why would the Fed charge commercial banks? Well, what if a commercial bank was making loans? They had a great day. Lots of people came in, they took out loans, and they're like, perfect, we made all of our excess reserves turn into new loans. We're going to generate all of that revenue as people pay back interest on the loans they took out. And the manager's like, good job, everyone. Thumbs up all around. Coffee is free tomorrow. And then Mr. Owen walks in, and I was like, hey, man, I'm going to take out some money out of my account. And they're like, oh, no, we have no excess reserves. And so they would be giving me money from the required reserves. Now, at the end of the day, when I upload my spreadsheet or my assets and liabilities to the Federal Reserve, it's going to show that, I have less than the required reserve needed. So my bank's going to get hit by a fine. Now, I don't want to get hit by a fine from the Federal Reserve. So one option I can do is I can borrow money from the Federal Reserve. So right now you're thinking, wait a minute, you're going to borrow money from the Fed so you don't get hit by a fee from the Fed? Yes, but I'll explain why that rarely happens in a little bit. So if the discount rate is the interest rate that banks charge, the Fed charges banks to borrow money, a higher interest rate, let's say a 5% interest rate, is going to curb my willingness to loan out all my excess reserves, right? If there's a really high penalty for something, I may not do it. I might keep some of my excess reserves chilling in my bank because I don't want Mr. Owen to roll in at the end of the day and say, hey, I want to take out some money. And they're like, oh man, Mr. Owen's taking out his money. We got to go to the Fed and borrow at 5%. That's steep. I don't want that. And so that would force banks to hold on to their excess reserves. So it would decrease the money that's going out into new loans and circulating through the money multiplier. Now, if the discount rate was really low, let's say 1%, then I might be a little bit more, what's a good word for it? I might be more willing to push the limit, right? 1%, that's not much of a punishment. I'm gonna loan out more money, and if it just happens that I don't have the required reserve rate, then I don't mind going to the Fed at 1%. So a big punishment is going to deter me. A 5% interest rate. There's my hand. A 5% interest rate from the discount. 5% discount rate would curb my lending, whereas a low discount rate would, encourage me to loan out more money. And so let's get the words out here so we can fill in our notes. So if Bank of America needs 10 million, they can borrow it from the U.S. Treasury. That's controlled by the Fed, but they have to pay it back with interest. So if the Fed wants to increase the money supply, expansionary money supply, increase the money supply, what should the Fed do to the discount rate? Drop it. They should drop the discount rate because the punishment is going to be less, and banks are going to loan out more money. So drop the discount rate, banks will loan out more money. If they want to decrease the money supply, if they want a contractionary monetary policy, you would increase the discount rate. Now, I put these terms in here just as a reference. Easy money supply, sometimes they'll say that when you have an expansionary fiscal policy, they call that like a loose monetary policy or easy money monetary policy. Tight monetary policy refers to a contractionary monetary policy. You're tightening up the supply of money. So sometimes we might see easy or loose for money supply or for monetary policy. If you see tight, that means contractionary. And then finally, the big one, open market operations. And this one might require a couple props. So I brought some props in here. So open market operations is the key thing that the Fed does to increase or decrease the money supply. Open market operations is when the Fed buys a bond. So let me flip my page there, make sure everything's ready for this one. Now, the Fed does this by buying or selling bonds. And again, this is the most important and widely used monetary policy. So here's the way I look at it. This is a bond. A bond is just a piece of paper. It's an IOU written by the Treasury Department, sold by the Fed for people to invest. You can have this. There it is. You can have this or you can have this. It's $5. It's a $5 bond. If I have this bond, it's a great asset. It's going to give 3% per year until it hits its maturity date, but can't do much with it. If I'm a bank and I make a lot of loans to a bunch of customers that might seem like they're, maybe more risky, maybe I also diversify by getting some bonds because I know the federal government's not going to default on this. So if I'm a bank and I have excess reserves, I might buy this bond. So this money goes to the Fed and I receive this bond. I can't do anything with this bond. All I do is collect interest on it. No new loans can be made from my bond. Now, if I'm a bank and I have a bond and maybe I want to make some new loans, like this bond is giving me a return of 3%, but I think that I can make loans of 5% and it's not risky, okay, maybe I sell this bond back to the Fed or to someone else. I'll take this bond and turn it into cash. This cash will go into my excess reserves. So this cash can be loaned out to new people. Bond does not increase the money supply. Cash goes into excess reserves and does increase the money supply. So let's try and take a look at this through a T-chart. That's right, another T-chart. So open market operations. So let's imagine here that this bank has $1,000 in checkable deposits. The required reserve in this economy is 20%. Move this over here. The required reserve in this economy is 20%. So this bank has to hold on to $200 in the required reserve. Now, looking at this bank balance sheet right now, their excess reserves should have been $800. $200 minus, or 1,000 minus 200 is 800. But this bank decided that they were going to buy some bonds. They're thinking, hey, I'm going to buy some bonds. I'm going to keep it safe. And they got excess reserves right here of 20 bucks. Now, if I'm the Fed and I see that, there we go, I'm the Fed and I see that Bank A has a bond or $600 worth of bonds and I want to increase the money supply, I'm going to buy their bonds. So if I look at this, I can say, all right, this bank can right now make $200 worth of initial new loans. We can work the whole problem out and see what the maximum increase. You know what? Let's do it. Let's say the maximum increase over time is 1 over our required reserve rate. So 1 over 0.2. My money multiplier is 5. So if I want to see what this bank can do to the economy, right now I would say my $200, that can be my initial new loans, times my money multiplier, 1 over the required reserve ratio. This bank can make a maximum change of $1,000 as a result of these excess reserves. But the Fed, they want to increase the money supply. They want to have the money grow more than 1,000 bucks. So they show up and they say, hey, look at that. You got 600 bucks worth of bonds. And they're like, heck yeah, I do. I got $600. And they're like, hey, it looks like $3, but it's $600. Can I buy your bond from you? And they're like, yeah, why not? I will buy that from you. So the Fed buys this bond from the bank. So the bank says, here, Fed, and the Fed says, here, bank, I will take this money and hand it to you. And so they hand it over to the bank. So this guy no longer has any bonds. They sold all $600 over to the Fed. The excess reserves, because all of that cash that looked like $3 but was really $600, went into the excess reserves. So now this bank can make initial new loans of $800. I'm going to call this initial new loan. I just made up my own abbreviation. Now, we still have the same money multiplier because we're not changing the required reserve. So if I take my $800 times my money multiplier of 5, we can see that the maximum change in the money supply over time is now going to be $4,000. We effectively increased the money supply, which dropped our interest rates. So here's how I remember it. Because I would think about it visually on the test and be like, who has the bond and who's buying it, or who's selling it. So if you want to increase the money, the Fed should buy government bonds. If they want to decrease the money supply, you would sell government bonds. And bonds and securities are exactly the same. So how do I remember it? Well, first, if I want to increase the money supply, a Federal Reserve Bank or a central bank, and a lot of tests will call it a central bank, a Federal Reserve Bank will buy bonds because the bank has this, the Fed has this. If they buy the bond from the bank now has this, and they can loan it out. So you buy big. And if you want to decrease the money supply, contractionary monetary policy, you sell bonds. So if you sell bonds, you make the economy smaller. All right, let's do some practice problems. So put me right there. Let's talk this one out. If you guys want to solve these real quick, I'll get a new page going. You can pause it, or you can watch me frantically shuffle around my garage. I'm a weirdo. Get a little squiggly in here.
Squiggly, sir. Hello.
Hello, sir. I'm going to turn my squiggly into a snail because I'm just wasting time right now while you solve these problems. And I'm a snail. Break this thing over into halvesies. Oh, crap. Look at that. There's the answers. That blew that one. All right. Well, cool. Let's, oh, shoot, is what I meant to say on that. This is on tape. So if the required reserve ratio is 25% and banks hold no excess reserves, that means anything they have in excess, they're going to make into new loans. An open market sale of $400,000 of government securities will do what? All right. So what do we know besides the answer sitting right there in front of us is that our required reserve is 25%. So if our required reserve is 25%, my money multiplier is 1 over my required reserve, 1 over 0.25. My money multiplier is 4. So they're saying that the Fed is going to sell, an open market sell, so sell small. So this is going to be a decrease in the money supply. So we already know it's going to be this one or this one. And by how much? Well, that $400,000 that the Fed is taking, right? Because the Fed is selling bonds, so the banks are giving money to the Fed. $400,000 times my money multiplier of 4. So 400,000 times 4 would be 1.6 million. It would decrease the money supply by 1.6 million. Wish I wouldn't have just blinked that screen like that. Pretty awesome, Mr. Owen. Way to go. To counteract a recession. Okay, so we're in a recession. What does that look like? Oh yeah, there's that graph again. But looks like my video paused. Hey, look at that. Oh, what you did today, you little recession? What you did, baby? It's AS and AD, long run aggregate supply. So we're in a recession. What should they do? So our options for a recession, you can reduce the reserve requirement ratio, you could reduce the discount rate, or you could buy government bonds. So we're in a recession. We know we have to buy government bonds. So I'm looking at these right now, and I'm going to knock everything off until I get to right here. So I'm going to buy government securities on the open market and lower the discount rate. So there's our answer. Lower the discount rate. I just called it R. Cool. And the next one, go to our next page. Beep, beep, boop. A purchase of bonds by the Federal Reserve will have the greatest effect on GDP if which of the following exists in the economy. Okay, so we need to find out what is going to affect the economy. What situation will allow a this expansionary monetary policy to grow the largest? So if you want to pause it, go for it. All right, for funsies, we've got A, B, C, D, or E. 1, 2, 3. C. Why C? Well, if the required reserve ratio is low, we have a low required reserve ratio. That means our money multiplier is going to be high. So whatever the Fed buys, it's going to be multiplied out more significantly than if we had a high reserve requirement. If, let's say, the reserve requirement is 0.5, then my money multiplier is only 2. If my reserve requirement ratio is 10%, then my money multiplier is 10. So we want to have a low reserve requirement. So this one works and this one works. And the interest rate has a large effect on investment spending. So they're saying large interest rate has large. So if interest rates go up or down, that's going to influence our spending. If people are watching interest rates and the Fed is dropping them, that's going to spur people to invest. Then that one works. This one says the reserve requirement ratio is low, and that works. And then they say that the marginal propensity to consume is low. If the marginal propensity to consume is low, that means our marginal propensity to save is high. Now we're looking at a spending multiplier question, right? That means the Fed goes out and buys these bonds. The bonds go into the bank makes the loans. People spend the money, but the guys that get the money are like, sweet, I'm going to save that in my account and never spend it. And then it wouldn't have a large effect on the economy. The next one says the marginal propensity to consume is high. Cool. That means if people did get that money that came in from the Fed expanding the money supply, they're going to go out there and spend it. But it says interest rate has a small effect on investment spending. So people are like, oh, I'm going to spend money no matter what. Oh, interest rates are going down. Okay, well, it really doesn't matter to me. So that one just doesn't work. So that one is C. This one is a beast. And this one I like because it's going to connect back to the information we've talked about bonds. So in the short run, which of the following would occur to bond prices and interest rates if a central bank bought bonds through the open market operations? All right. A, B, C, or D? 1, 2, 3. C. Okay. Why? You're like, what the devil? How does bond prices even have an effect on anything? Well, let's get my snail back on here. What they just said was that our money supply, this is our money demand, QE, this is quantity of money, and this is my nominal interest rate. All right, so if the central bank bought bonds, they bought bonds, buy big. When you buy bonds, you increase the money supply, MS to MS1. So interest rates went down. So if interest rates went from, let's say, 5% to 3%. So if interest rates decrease, then people who had older bonds that were paying a larger return, those are going to be more valuable because you might have had a bond that was a $100 bond and it was paying 5% for 10 years. So 5% times 10 years would be 5, so 5% times 10, so is that really? So 0.05 times 100 is 5 times 10. Yeah, that's $50. That's sweet. Okay. So I guess I'm just not used to seeing interest rates of 5%. It blew me away. All right, so this means this guy is going to pay off 50 bucks in the long run, and in 10 years you get your 150 bucks back. New loans of $100 are going to have a lower interest rate. Are going to have a lower interest rate because the Fed dropped the interest rates. So all new loans are going to give a 3% return, which means you're going to make a total profit of 30 bucks in 10 years. And in 10 years you get 130 bucks back. So people aren't going to want to buy these old bonds. They're not going to want to buy these old bonds. They would prefer to buy, people would not want to buy these new bonds because the interest rate is lower than the previously issued bonds. This guy could bid up the price of that bond and people would still buy it because if he sold that bond for 110 bucks, when you eventually get your 150 back, you made a profit of 40 bucks. You're still doing better than you would have with that guy. So bond prices and interest rates are inversely related. That was supposed to be an up and a down. If interest rates go up, previously issued bonds will decrease in value. If interest rates go down, previously issued bonds value will go up. And College Board loves to ask this question because it's showing the connection between Unit 3, Unit 4, and they love to do this also with crowding out effect because crowding out effect can also have an effect on interest rates. All right. So how does this all play out? Now, not a minute ago, probably a long time ago now, looking at how the time is just flying by, we have, it's called the federal funds rate. The federal funds rate is let's use our words first. Let's get these notes out and then we'll do it. Federal funds rate. Federal funds rate is the interest that banks charge one another for one-day loans of Federal Reserves. So what does that mean? Sometimes, loan of reserves. So sometimes a bank, like I gave the example earlier, makes a ton of loans in a given day. And they're like, oh man, I did so well. I made all of my excess reserves turn into new loans. We're going to do so well. And then Mr. Owen walks in, takes out a loan, and they're in big trouble because their excess reserves is now smaller than it should be. They can go to the Fed and borrow money, or they could go borrow from another bank. Because what if you're another bank, like Bank of America? Let's say let's get a squiggly quick. Stay focused. Okay. So I got all these banks. I got Bank A, I've got Bank B, I've got Bank C, and I've got the Fed up here. Now, if Bank A is short, if Bank A is short on their required reserves, they need to borrow 100 bucks. What happens if Bank B has excess reserves of $200 at the end of the business day? This 200 bucks sitting in their excess reserves is going to do them no good during that night. So Bank A can call up Bank B and say, hey guy, I was wondering, can I borrow 100 bucks? And they're like, heck yeah, you can borrow 100 bucks. We'll loan you that 100 bucks. Their excess reserves are now 100. These guys now have the required reserves they need. They still have zero excess, but they have the required reserves they need, so they're not going to get hit by that fee. They call this the federal funds rate. So whenever banks borrow from each other, they call that the federal funds rate. So federal funds rate is when a bank to bank makes a loan. And why do they call it the federal funds rate? Because really you're just shifting around your file at the federal funds. But it bothers me because it's bank to bank and it's called federal funds rate. Whereas if a bank goes to the Fed, so if Bank A doesn't find anybody, like they loaned out everything and then someone dipped in, they've loaned out everything, but they're chilling. They loaned everything out, but they're chilling. They're like, I've called everybody around here. I can't borrow any money. When a bank goes to the Fed, the bank let's move my little head out of here. When it goes bank to Fed, they call that the discount rate. Well, that's lame. I would have preferred the federal funds rate to be where a bank borrows from the Fed. That would be easier to remember. And you're like, yeah, that would be easier to remember. But wait a minute, this is where it gets even worse. The discount rate will always be 1% higher than the federal funds rate. Now, why is that? Because the Fed doesn't want to get into the business of loaning money to banks at the end of every business day, because that would just blow up the size of the Federal Reserve. You'd have to have way more employees. That's crazy talk. Why not just keep the discount rate 1% higher than what these guys are borrowing from each other? So if a bank to bank or a federal funds rate is 3% between Bank A and Bank B and Bank C and Bank B, then the discount rate would be 4%. Why does that suck? Because it's not a freaking discount. It's more expensive. So this whole naming system is super lame because if it's bank to bank, it's called the Fed, even though it doesn't involve the Fed. If it's a discount rate, it involves the bank to the Fed, and it's not a discount, it's actually more expensive. So, nice. But why is this all important? The Fed will use their open market operations to track this federal funds rate because they can see what banks are charging each other. And the more excess reserve a bank has, because as the Fed buys their bonds, they have more excess reserve. They have a surplus of excess reserves. You want to get rid of your money at the end of the day. If he's only got 200 and he's got like 800, he needs to get rid of that giant surplus of excess reserves and make money for one night, just one night. It's still your money making money. When you have a surplus, what do you have to do to the price? To drop the price. So the Federal Reserve watches what these banks are charging each other by influencing, well, basically it's tracking what they're doing with the banks, but by increasing the money supply, they have more excess reserves. To get rid of those excess reserves, they have to drop their federal funds rate. So that's where that comes from. Cool. I am going to pause this video because I'm having some upload issues. And then these FRQs on this content, I'm going to post an additional video called Module 9 FRQs. Where'd my thing go? Where did I pause you? There you are, friend.